Welcome back to the What's More podcast. I'm your host, Quentin Harris, and you are dialed in for the most recent episode here at What's Your One More. So we just came off of a demographic talking about the housing market and the potential wave of buyers that are in the loom or pent up demand, if you may. I kind of want to broach this episode from what's going on in the demand sector as far as purchase applications, as well as new home growth. And don't look now, but we're starting to see that spread evaporate on the 10-year that we've been talking about. Could this be the result of the Federal Reserve cutting 50 basis points, or is this just the economy moving in the direction in which we've been anticipating? We'll talk about that and more on this episode at What's Your One More. All right, so welcome back. A couple of things we want to talk about here. Let's just jump right into it. Mortgage applications have always been, in my opinion, this leading indicator, if you may, about demand. We hear it all the time, especially on our YouTube channel at What's Your One More. And if you'll check that out at What's Your One More, if you're listening to this on audio, we're going to put a couple survey questions in on our Spotify account. If you're not checking that out, the video's on there as well. But you're going to see a survey question about, hey, what rate does it take for you as a homeowner to refinance your home or sell your home? And the second question will be, if you're not a homeowner, what rate's going to attract you to the market if you're currently not looking and not in the market? So if you would answer those two questions for us, we'd greatly appreciate it. So let's jump right into mortgage applications. So for me, this information comes out every Wednesday, and we get it in two forms from the MBA's Mortgage Application Index. That's the Mortgage Banker Association Index. We get purchase information and we get refinance information. And oftentimes those are combined into one index. But what I'm going to focus on here is purchase demand. And for me, something I take a look at is that we've had 5 prints. This comes out every Wednesday. So we've had 5 weeks in a row of increased purchase demand. So that's taken us back from we're almost through September. That takes us into the month of August, all the way through September. We've had 5 significant prints of increase. Now, I put a graph here in the YouTube channel my producer is going to put in here, and you'll see 2022 measured over 23 and then currently at 24. And what you see is that for the first time in 2024, we've actually surpassed 2023, meaning that the year-over-year increase is positive for the first time. Now, that should be a red alert to anyone listening to this. It was to me when I saw that, because this is confirmation that, okay, wait a minute, now the demand has entered the market, but increasing, meaning that we all can agree 2023 was one of those years where it was like, oh, the Fed's not giving us any relief. We saw 8% interest rates. Now we're not there. I'll talk about that spread at the tail end of the show and what's happening here on the 10-year Treasury. But what we're seeing is that the demand is meeting the required interest rate market for those appetites to start to become satisfied. And I'm curious, in those questions I asked earlier in the show, if you'd answer those, if that confirmation is going to be validated by our audience. So I would appreciate if you guys could do that. That would help us out. But again, going back to 5 prints. So over the last 16 prints, we've had 11 positive ones. We've had 5 negative ones, but we've had 11 positives. If you go back to the prints before that, if you go back to the previous 16 weeks, there was an opposite trend of what I just described. So what we're seeing is we're starting to see, maybe it's just that pent-up demand rising to the surface. And we talked about where that's coming from in the previous episode. Looking back, probably could have combined both these episodes and made one, but that breaking them up makes the data a little easier to digest. Plus, we got further confirmation of it here this week. But this is important. This tells me that buyers now are saying, hey, you know what? This rate with a 6 handle on it, yeah, I'm pretty comfortable with that. These price points, okay, they're not as bad as I thought they were. They're not great. They're not where I want them. Don't get me wrong. But they are okay, and I can digest that, and now I'm interested. So let's go to the price point. This was interesting to me. So again, I continue to say there's a lot of naysayers in our community that want to talk about this doom and gloom. They want to talk about what had happened in 08 and 09. And we've talked about, I think on countless shows now, how that's not going to happen and why it's not going to happen. Even the most previous episode I just did gave you all of the data sets to show the supply is far less than the demand. And the pent-up demand is scary that's out there. What we're seeing now is the CoreLogic and the Case-Shiller Index that goes along with the CoreLogic is confirming that data as well. And the FHFA, these are the 2 indexes that kind of show home price appreciation month over month. But I'm going to stick with the CoreLogic Case-Shiller here, because the reason this is important is it's at the highest it's been ever. It's a new high. So what this is saying is that this includes all purchase transactions that are under cash, that are also under financing. Now, you've heard me in previous episodes talk about, traditionally speaking, why the Case-Shiller Index should be less than the FHFA Index. That's because when you're operating with cash in the equation, cash is king. You should be able to get more deals, if you may. If you went to a seller and you said, hey, listen, I know you want 500 for the home, but I'll offer, let's say 490, 495 with cash. You're probably going to get that. There's some bend in that price point. So that's what the Case-Shiller kind of absorbs in this. But this has now hit a new high. And don't look now, that's completely validating what we've been saying about not enough supply and the demands coming to the market. I don't think that it's ironic that this index has hit a new high when we've had 5 prints of positive territory in mortgage demand applications. These things go together. And for me, what's important about this is if you look at the FHFA, why is that important? Well, here's why that's important. That's the index that determines the conventional loan limits. That's the index that also helps determine what the outlook's going to be for the government limits on FHA. So what are we seeing here? Well, we're seeing more positive prints, and more importantly, you're going to see the current conforming loan limit get damn close to 800,000, and that's going to get announced in November. Right now, you're already seeing lenders, you're already seeing people in the community go, hey, listen, we'll do 795 or 802. I think I saw where, UWM came out and said they're going to be the highest at 802 and some change. What's significant to me, though, is that you are jumping from a 766 to an 800,000 or 795. Here's why that's important. Because now that buyer can buy that home with 5% down on that particular loan size. That is going to add more affordability to the market, but more important, more price pressure to the market. I continue to say that where affordability shows up, price pressure follows real quickly right after that. Same thing with rates. If rates come down, affordability will show up, price pressure will follow immediately in the form of demand or sellers absorbing that. That's the downside of affordability showing up. It just dissipates very quickly. So one of those things, if you're in the market, look to buy a home, keep that in mind that you may want to be ahead of that curve, right? And the loan limits are going to get announced here in November. They're already kind of being teased and I've already seen lenders out there kind of taking on this risk and saying, we'll do it that way anyways. We're good with it now the way it is. But that Case-Shiller Index is further confirmation along with the prints of what's going on. As I talked about on the 10-year Treasury, here's something to think about. So the 10-year Treasury has kind of been, my friend Barry Habib uses this term, vacillating between the 3.5 and the 3.8 range. And if you've heard us talk about, traditionally speaking, you should be able to add 1.5 to that, and that's your mortgage rate. Well, obviously, because of what happened in 22, that's not the case. But what we're also starting to see happen, just like the prints, just like the positive prints in the last 5 weeks. Over the last 5 weeks, we've now dropped below the 2022 trend line of what was going on in 2022. We actually had an inversion that happened. And that's important because what we're seeing now is the same thing. The spread is starting to evaporate. And instead of being at 3.25 and 3.5, we're at 2.5 right now. So you should be able to take the 10-year Treasury at 2.5, and that's the current market rate. Eventually, we're going to get back down to that 1.7, 1.5. And you can see what's happening here, and you can see the dissipation of that. And that's one of those reasons we continue to talk about the Fed cutting rates at 50 basis points doesn't do as much relief in the market as what I'm talking about right now, which are those spreads. And I think for the first time, what we noticed with the bond market in particular is the bond market is way ahead of the Federal Reserve. What I mean by that is that the Federal Reserve is kind of slow and old in their thought process of data and data sets and data dependency. They even acknowledge that some of the old models are no longer sufficient. That's why they're calling people to ask questions, in particular to the labor market. And what they're going to find when they make those calls, and I guarantee you what they're finding right now, is it ain't good. And that's why you're seeing people like Goolsbee, who is a Federal Reserve member, coming out and say, listen, I think we're way above neutral. We're still in restrictive territory. We could probably use another 100 basis point cut. That's a Fed member. Now, he's very dovish, but the fact that he's come out and said that, it's kind of setting the tone of what could be coming down the pipe over the course of the next 6 meetings. And here's what's happening. The bond market has figured this thing out from a perspective of it's no longer about inflation. The PCE reading is getting ready to come out. Today's Thursday, the 26th when I'm recording this. The PCE reading is getting ready to come out. The bond market has already figured out, okay, no matter what that is, barring some great jump to put us over 3%, as long as that's got a 2 handle on it, the Fed feels comfortable right there. They've getting towards their target rate of inflation. But what they figured out is this data in regards to unemployment rates. That's where the real issue is. And you can bet that that's what they're paying attention to. And jobless claims is what they're actually looking at in real time. That's every Thursday. And matter of fact, it just came out, and I'm looking at my economic data. It just came out while I'm sitting here. It came in at 218,000 jobless claims, meaning that 218,000 new people showed up to go get unemployment numbers at the unemployment office. And so that's interesting. The forecast was 225, so it came in, slightly less than what it should have. And the market reacts to that. You're already seeing some sort of downward revisions right now because it didn't come in at the forecasted amount. And so that's telling the market that, hey, listen, not everybody's showing up for unemployment numbers, so maybe we're not losing as many jobs. But I go back to that conversation that we had in regards to the U6, which is how many people are unemployed that are not taking unemployment benefits, and that number is still substantially high. So I think that what I'm getting at with this is the bond market has to say, hey, listen, we're going to pay attention to the unemployment rate. We're going to pay attention to the job reports as it comes out, and those are the things that are going to move the mortgage needle much greater at this point, but in between meetings, than anything the Federal Reserve says or does. And I think that's something to pay attention to because we're already starting to see the impacts of that. Last thing I want to lead us with. So I've done about 2 episodes on these trigger leads. And to me, this is, you can tell by how passionate I am that I don't like them. And there's a reason why I don't like them, because it's an invasion of privacy for every consumer. It's something that started in 2002 that was an absolute joke the way it was presented. It was abused, and practices are abused by the mortgage industry on a constant basis, even today. And you know what I'm talking about. If you've applied for a mortgage loan with a particular lender, and within, 20 minutes of applying, you have multiple phone calls of people disguising to be themselves with that lender or actually propositioning you for a new loan, and you're like, how did this happen? That's a trigger lead because your data is being sold. And I've got 2 episodes where we go in depth about how this was created, why it's done, and what's going on. And then we talked about the bill that was being presented. And the original bill was the Homebuyer Privacy Protection Act that was put out there that kind of flamed out. It didn't go anywhere. And the people presenting the bill tried very hard to get it passed. It never made the floor. However, kudos to the Senate, because now they've put this in the National Defense Authorization Act. This is now bundled with other things that are going to get passed. And where I'm going with this is extremely important because this has a rule that bars the furnishing of the credit information to any type of person that would use it to solicit someone that did not pull that. And this is something our industry needs. It's very, very critical to protect the consumer and protect the mortgage lenders involved in this. And ultimately, it's a privacy, non-public, private information data breach that's happening. This is very important. And kudos to the legislation for getting that in there. And I can't wait for that bill to get passed. It will mean very great things for the consumer as well as the mortgage lending industry as a whole. So very excited about that. So guys, if you like what you're hearing, if you would, please 5-star review this podcast. Check us out on Apple, Spotify. Answer those questions on Spotify. For the graphs and all the information from our show notes, it'll be at our YouTube channel at What's Your One More with the number 1. Guys, thanks for tuning in. We'll see you at the next episode of What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.